Welcome back, everyone. Michael here with Offshore Citizen. We're in beautiful Dubai, and today we're going to discuss the subject of taxation for people who are doing day trading or earning money from capital in sort of an active way. So this will, to some extent, apply. We'll cover a little bit about, what if you're getting dividends or interest or something like that from your money? What if you're doing something like yield farming or staking, etc. in these things? So we will go through that. I'm also going to talk to you a little bit about various different asset classes, because I think some people get a little bit thrown off by this, whether it's, hey, I'm in crypto or I'm in Forex or I'm in whatever. And I'm going to cover for you some of the exceptions as well. And so, it pays off to know how you can pay less tax and what the consequences are in different countries, because that makes some difference as well. So let's dive in. Before we do that, if you haven't already, please smash the subscribe button, nail the notification bell, make sure you don't miss out on any of our future videos. Try to produce great content for you every single day. We really appreciate you subscribing. And if you would like help at all with the subjects of moving abroad, international structuring, setting up your company internationally, paying the lowest legal amount of tax possible, either the strategy of what the best solution is for you or help with implementing it, please reach out to us. You can book a call with me, clarity.fm/Michael Rosmer. There's a link in the description below, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and you can send us a message through there. Okay, so I've had quite a number of people reaching out to me lately who have been making money in, whether it's trading, right? It might be swing trading, might be day trading, scalping, whatever, or you're in a situation where you have some sort of kind of financial asset thing going on. So yield farming is a common thing in the world of DeFi today. And so, yeah, worthwhile to sit here and kind of dive in a little bit into how you should think about these things. I've had some people mention lately that they've talked to accountants, and the accountants don't understand it and don't understand how it should be taxed, and so on and so forth. So let's start with the notion that there are some countries where there are specific exceptions. I've talked previously about in UK how FX gets taxed in some different ways, partially depending on the category of person that you are, but how spread betting is different and things like this. Likewise, in Portugal, you can pay attention to the fact that crypto is taxed a little bit different. I'll do a video specifically on Portugal's taxation of crypto because that's something a little bit confusing for people. Netherlands has some different rules. Germany has some different rules, etc. So anyway, we're going to go through it. The first thing I think is it's helpful to understand that although you might have something like, people maybe will fixate on like, hey, I'm doing this with crypto. And whether it's crypto or it's commodities futures or it's currencies or whatever, you can usually relate it to something similar, okay? Let's use an example. How is crypto trading really different from trading any other underlying asset, right? Say you're talking about something like, trading stocks, right? Likewise, let's say that you work for a DAO, right? You're like, okay, great, I work for a DAO and I'm getting given tokens that are vesting, right? Well, how is that different from being given shares, which are vesting, okay? Now again, country by country, there's lots of different rules, so reach out to us if you have specific questions or, to find out how it applies to you, but it's worth drawing some of these analogies, right? Likewise, some people will contact me and they'll say, hey, listen, I'm working for a DAO and I'm being paid in crypto, how do I get taxed in that case? So loosely speaking, there are typically, I guess we would say like 3 basic buckets that are common in terms of income. Okay, so the first one is earned income. And here's the reality. Whether you're paid in stocks, whether you're paid in crypto, whether you're paid in dollars, whether you're paid in vehicles, earned income is taxed as earned income. Okay, the currency that you're paid in does not change the taxation structure that you're dealing with. Okay, so that's fairly straightforward. Next, there is stuff like dividends income. Okay, so dividends income is a little bit different. It's because of the fact it's technically earned income, but it's coming from after-tax profits in a company. Interestingly, likewise, you can actually receive dividends in the form of real property. It doesn't necessarily have to be dollars. So somebody would say, well, how do I account for the value of this? Usually, if you're paid in some asset which is not a dollar, you're usually going to count the value of it at the time that it was received. Okay, usually. Again, there's some exceptions, but usually that is the situation. This is going to be true Again, whether they could pay you in gold, they could pay you in diamonds, they could pay you in fine art, they could pay you in whatever. And the same is true of your business. If your business says, hey, listen, we've decided to do a distribution, and rather than selling, our vehicles, we're going to distribute them as assets to our clients. Perfect. Okay, great. You can go ahead and you can do that. Bottom line is, it is dividend income because it's already been taxed at the corporate level. Okay. The third thing that you'll have is you'll have basically income from capital. Okay. Now, this can usually fall into two categories. So if you're earning interest income, usually that's actually considered to be earned income. Okay. And the distinction here is I had X and then I was given more. And maybe it's given more of X or it's given, whatever. But you're given more as opposed to the value of the thing that you have growing. Okay, so that's a little bit of a difference. And why is that important? It's important because usually when the value of the thing that you have grows, it can also decline. And that's why there's a different set of rules, right? So let's use an example of a bond. If I have a bond, right, the coupon that is being paid to me, the interest rate, right, that's not, the interest that I'm paid doesn't decline. Okay, you can have currency fluctuations and things like this. But, when I get paid X, that's what X is worth, right? Versus if I have a stock, I could buy the stock at $100 and it could go up to 200 or it could go down to 0, right? So it's a capital loss in one case and it's a capital gain in the other case. Pretty much everything that you're looking at can be accounted for in these different categories of income, okay? And it's worth just thinking about that as you're going through. So I get a lot of people who they fixate on the instrument as opposed to fixating on the mechanism. So did I work to earn it, right? Did it work for me to earn it? Did some other entity earn it for me and then pay it out after taxes? Okay, so has it been taxed? Yes or no? And is it earned or is it unearned? So anyway, that's kind of like a little bit of a mental model. Hopefully that's helpful. Again, if you have questions, if you're in a weird situation where you're earning in some other currency, like I said, country to country, there are some differences in what the tax treatments are going to be, right? But definitely reach out to us. You can book a call with me, clarity.fm/Michael Rosmer, link in the description below. We can discuss your situation, and we can go over and find out what makes the most sense for you. I hope you liked the video. Give it a thumbs up. Let me know other stuff that I can do. If there's some way to improve, please tell me in the comments, and I'm going to see you guys on the next video.